This video is for lesson 13.2, recording employer payroll taxes. We have one objective here. You need to be able to calculate and record employer payroll taxes. So employer payroll taxes, we talked about in the last section that the employer is responsible for paying Social Security and Medicare, just like the employee is. The employer also needs to pay federal unemployment tax and state unemployment tax. Federal unemployment tax is a federal tax paid by employers to administer the unemployment program. We will often refer to this as FUTA. And then the state unemployment tax is a state tax paid by employers that's used to pay benefits to unemployed workers, and that is commonly referred to as SUTA. So I will often just refer to them as FUTA and SUTA. So here they're showing us how we're going to calculate our unemployment taxes. We have our employees in this first column. In the second column, we have prior accumulated earnings. And then in this third column, we have earnings to equal the FUTA tax base. Then the fourth one, earnings for our current pay period, and then our FUTA earnings. So when we talk, they don't actually tell us on this slide, but when we talk about our unemployment taxes, we pay the employer pays unemployment taxes up to $7,000 of earnings. So when we look at this, we're saying that John's prior accumulated earnings were at $27,000, and then we see earnings to equal the FUTA tax base is 0. That means that he's already reached that $7,000 tax base. So therefore, we don't have to pay any taxes for unemployment for John anymore. This column here is just showing his current pay period earnings. Even though he earned that $1,466, again, he's already reached that tax base, so we don't have to pay any taxes. So when they look at the FUTA earnings here, the FUTA earnings is the amount of earnings that we use to calculate the taxes. So this is going to be 0. Let's go ahead and look at Anthony then. Anthony's prior accumulated was $5,260. So to figure out this number here, what we're going to do is we are going to subtract. We're going to take 7,000, which is our tax base, minus his accumulated earnings. That means for Anthony, we still need to tax $1,740 of his earnings. When we look at this column, this is what he earned this pay period. So this pay period, he earned $1,494. That means that we are going to tax this whole amount of $1,494. If we look at Anne has prior accumulated of $1,648. Again, to figure out this column 3, we're going to take 7,000 minus that prior accumulated. So we still need to tax $5,352 in earnings from Anne. Now, Anne only earned $240 for this pay period, so therefore we can only tax $240 of her earnings for unemployment taxes. When we look at Mary and Justin, both of them have already surpassed that $7,000 tax base. So therefore, we can't tax any of their earnings, even though they have earnings from this pay period. We are not going to tax any of those earnings. And then the last one, Carrie. So I'm going to just kind of summarize what we're going to do for each column. Here's her prior accumulated. To get this number, we're going to take 7,000 minus prior accumulated to get 510. This is going to be her current pay period earnings. And then what I find is almost easiest for this column 5 is we're going to look at these two columns and we're going to figure out which one is the smaller number. So 510 is our smaller number here. So we can only tax $510. Even though Carrie earned $1,444 that pay period, we only have $510 left to tax to get to that tax base of $7,000. So we can only tax that $510. Then we are just adding up all of our FUTA earnings, so what we can tax for unemployment tax here. So on December 15th, we recorded employer payroll taxes expense, $757, for the semi-monthly pay period ended December 15th. Taxes owed are Social Security, Medicare, federal unemployment, and state unemployment. So here they put it into our T account so that we can see what this looks like. This is a debit to our expense account, and then we are going to credit all of those payable accounts. Remember, these are liabilities. What we're doing is we are setting this money aside until we actually pay the government. This is going to go to our general journal because we are not actually paying these taxes at the time. So we are going to put in the date. We're going to debit our expense account. Here, our expense account is our payroll taxes expense. And then we are going to credit our payable account. So Social Security tax, Medicare tax, unemployment tax, federal, unemployment tax, state. Now, the big thing that I would say that students get confused with Chapter 13 is that in that previous 13.1, we looked at the payroll expense. That was where we had our salary expense and we paid cash to our employees and we withheld all of their taxes. In this transaction, we are just looking at the employer and we are just recording the employer's side of taxes. So again, the employer and the employee pay Social Security and Medicare, and just the employer is going to pay those FUTA and SUTA taxes. We are not actually paying these taxes right now. We are just setting that money aside so that we can pay the government at a later date. Number 1, what is the tax rate 3 Green must pay on employees for each of the following taxes? Social Security, Medicare, federal unemployment, and state unemployment. So Social Security is 6.2 for a maximum of $106,800 in each calendar year. Medicare is going to be 1.45% of the total employee earnings. FUTA is going to be 0.8% on the first $7,000 earned by each employee. So there's that tax base. And then SUTA is going to be 5.4% on the first $7,000. So it also has a $7,000 tax base. Number 2, what is the amount of each employee's earnings that's subject to federal and state unemployment taxes at 3 Green? That's that first $7,000 of earnings. That's the end of 13.2. You can now go to the 13.2 work together.